Hello, it's Marquez here from bsresearch.com. If you have been watching my videos for a while, you already know my stance that Bitcoin's Satoshi Vision, or Bitcoin SV, is a superior form of money. It is a superior digital cash system, and it's a superior payment method. In this video, we're going to dive into specific examples to show you exactly why I think that is. We'll break down what happens when you pay with a credit card and then compare it to what happens when you actually use Bitcoin SV. And by the end of this video, I hope that you'll see just how complex and expensive traditional payment methods are compared to the real Bitcoin SV. For clarity, when I say Bitcoin in this video, I mean Bitcoin Satoshi Vision, BSV, the one that's priced at about $50 per coin, not the BTC one that everyone thinks is Bitcoin, the one that's priced at $90,000 at the moment. Many people in developed countries rely on credit or debit cards to buy goods and services online. But for billions of people worldwide, accessing these systems is neither easy nor affordable. Banking services often require significant resources, making them out of reach for those in underserved areas. If you are watching from a part of the world where credit cards and online purchases feel irrelevant or inaccessible, stay with me, because later in this video I will show you how Bitcoin SV can serve as an alternative cash system, one that will enable you to trade with others, much like credit cards do for people in developed nations. And all you will need is a mobile phone or a laptop that's connected to the internet. Before we explore how Bitcoin SV works, let's first examine a typical online purchase and ask what is required to transact with a credit card. To start with, the buyer, let's call him Ben for now, needs a bank account. He needs to set one up. Ben must provide identification and other documents to the bank. The bank reviews his application, performs checks, and, if approved, issues Ben an account. They then give him his account details and access credentials to manage his finances online through a website or an app. The process is similar for businesses, though often more rigorous. Let's consider a merchant named Jill. Jill runs a business selling items like books, clothing, and everyday groceries, such as canned foods, milk, and bread. And she also offers delivery services for her customers. For Jill to accept online payments, she needs a bank account and potentially a merchant account, which comes with additional requirements and fees and setup processes. So now that we've outlined the basic prerequisites for online credit card transactions, let's move on to what happens during the actual purchase and then compare this process when using Bitcoin SV.
So we are going to go through a typical credit card transaction. It's a generalized model, which means in reality the transaction flow may vary. But this process shows you the crucial parties and the functions that's necessary to process a credit card transaction. So the journey begins with the cardholder or the customer. In our example, it's Ben, who wants to buy goods from the merchant. In our example, Jill. This is an online transaction, so Ben is on his laptop or desktop computer or maybe using his phone to browse Jill's website. He chooses the items that he wants to buy and then adds him to his digital shopping cart. Once it's done, he would check out, and the first thing he's going to do is to choose the brand of his card. Like, is it a Visa or is it a MasterCard or something else? In our example, we're just going to focus on Visa and MasterCard because they are the two biggest brand cards out there. Ben would indicate what brand of credit card he wants to use. So let's say he wants to use a MasterCard. He chooses the card, authenticates it by typing his PIN. That's step one. And then a technology company that provides the function of a PSP, payment gateway services and acceptance. Their job is to collect this data from the website, find a way to encrypt it, and be able to transfer it in a format that acquirers understand safely and securely. So the payment gateway forwards the details of the transaction to the merchant's bank, which is Jill's bank, in this case performing the role of the acquirer. The acquirer then checks the contract that he has with Jill, the merchant, to make sure that all is okay, checks for any signs of fraudulent behavior, and then because the customer has chosen which brand of card he's got, in this case Ben has already indicated that he's using a MasterCard, then the scheme uses the BIN number of the card, which is usually the first 4 or 6 digits of the card, to determine which bank or issuer has issued the card. It then transfers the data of the transaction to this issuer, and when it gets to the issuer then checks the contract, checks the status of the card, makes sure there's enough money in there, checks if there's any signs of fraudulent behavior, and if everything is okay, it reserves the amount and authorizes the transaction, or declines it also. It sends the message, whether it is authorized or not, back to the schemes like Visa and MasterCard, who then forwards that message again to the acquirer. It then goes to the PSP, who then feeds it back to the merchant. The merchant then confirms the transaction and the final amount back to his bank, the acquirer. The acquirer then registers that transaction and sends that information back to the merchant. At the end of the day, it sends all the transactions that it's collected to the schemes. So it sends all the transactions of Visa to Visa and all the transactions to MasterCard to MasterCard. The schemes, like Visa and MasterCard, then accepts these as cleared transactions. The schemes then, like Visa and MasterCard, bundle their transactions and sends them to each relevant issuer. So the issuer then receives all these clear transactions from Visa and MasterCard and all the other schemes they're working with. In our example, the issuer then books the transaction, Ben's transaction, on Ben's account. Now, up until now, the only thing that's been happening is basically data being recorded on these entities' computer systems. No money has actually been transferred. It's only at the final stage, the settlement stage, where money is actually transferred. It begins here at step 12. Payment scheme debits the issuer settlement account and credits the acquirer settlement account, to be effectively taking the money away from the issuer and giving it to the acquirer. And at step 13, the acquirer then pays the merchant. And at the end of the month, let's say, the cardholder, or Ben, then decides to pay the money that he owes the credit card, or his bank. That's the final step. Step 14. So that's basically how a credit card transaction works. Now, like I said, this is a generalized model because, for example, in some cases like American Express is acting like the acquirer, the scheme, and the issuer. So, like I said, in reality it could be a bit different, but this shows you the different roles and the different institutions that are involved in processing a credit card transaction. We're going to take a look at the cost. How much does all this cost? Who pays who? Well, we do know that the card holder, Ben, has a bank, and he pays that bank fees for the privileges of having and using a credit card. So we know there's fees there. We also know that the merchant pays their bank a cost as well for their services. So that's this arrow here from the merchant to the acquirer. We'll call the cost merchant services fees. Transferring payment data is a very complex thing. So most merchants don't do that themselves. They rely on the services of PSPs, who then works out a technologically and compliant way to transfer data in and out of their websites or apps. So we also know that the merchants pay PSP fees to provide services for payment gateway and acceptance services. So we know there's money going there. We also know that the schemes receive money from the acquirer for doing their job, and also from the issuer for doing their job. And we also know that the schemes take money from the acquirer and the issuer for using their cards. So that's cost number 4 and cost number 5, scheme fees. And finally, we know that the acquirer pays the issuer interchange fees. Again, more fees. So these are the costs of running a payment system based on fiat currency. All these fees and costs add up to about 2% to 6% of the transaction amount. In some cases, like international money transfers, it can be up to 13%. And who pays for all these companies, organizations, and institutions? It's ultimately all of us, the consumers. It is these costs that Satoshi Nakamoto wanted to reduce through Bitcoin. On the Bitcoin white paper, he wrote that commerce on the internet has come to rely almost exclusively on financial institutions serving as trusted third parties to process electronic payments. While the system works well enough for most transactions, it still suffers from the inherent weaknesses of the trust-based model. Completely non-reversible transactions are not really possible since financial institutions cannot avoid mediating disputes. The cost of mediation increases transaction costs, limiting the minimum practical transaction size and cutting off the possibility for small casual transactions. And there is a broader cost in the loss of ability to make non-reversible payments for non-reversible services. With the possibility of reversal, the need for trust spreads. Merchants must be wary of their customers, hassling them for more information than they would otherwise need. A certain percentage of fraud is accepted as unavoidable. These costs and payment uncertainties can be avoided in person by using physical currency, but no mechanism exists to make payments over a communications channel without a trusted party. What is needed is an electronic payment system based on cryptographic proof instead of trust, allowing any two willing parties to transact directly with each other without the need for a trusted third party.
So how can the real Bitcoin, BSV, improve on the current fiat-based system as cash, as a payment system, and a payment method? Going back to the costs of transaction flows, which basically indicates to us the connected contracts between all these parties, we can simplify this diagram by moving the icon representing the card holder next to the icon representing his bank, the issuer. That simplifies that image, and let's clear all the arrows, and this way the card holder or the customer is on the opposite side. And here we can see that the merchant, Jill, and the customer, Ben, for them to be able to transact with each other, they need the services of a PSP, or the payment service provider, the acquirer, the schemes, and the issuers. So there's a lot of these institutions that actually get in between. And the interesting thing to point out here is that the transaction between the customer and the merchant is not peer-to-peer. It's not direct. Now that we've dissected how traditional credit card payments work, let's turn our attention to why Bitcoin BSV is fundamentally different and why it delivers on the promise of true peer-to-peer transactions. When you use a credit card, you're not really spending your money at the point of transaction. Instead, you're promising to pay the bank or the issuer for covering the expense. So effectively, credit cards are debt instruments. They work based on a line of credit that you repay later, often with interest and associated fees. Even debit cards, which are more directly tied to your personal funds, rely on complex intermediary processes that involve multiple banks, payment gateways, and schemes, which add layers of cost and friction. These transactions are not direct exchanges of value. Rather, they involve borrowing or intermediating value through trusted institutions. And by contrast, a Bitcoin SV transaction is more like using cash. Imagine being at a market stall where you are physically handing over a banknote to buy goods, and there's no third party involved. There's no one to verify or mediate the transaction beyond the two people engaged in the exchange. And this is the simplicity that Satoshi envisioned for electronic payments. And it's exactly what Bitcoin SV accomplishes, even on a digital scale. A lot of these processes, these entities, and the functions that they serve become no longer relevant with the Bitcoin transaction. These institutions here are basically replaced by the Bitcoin Satoshi Vision Network, the BSV network. When you pay with Bitcoin SV, the transaction is added by a payment processor, often referred to as a miner, to the blockchain. A miner is simply a computer that processes transactions according to the rules set in stone by the Bitcoin protocol. Anyone with a technical know-how and a little bit of money can be a miner and start earning mining fees in BSVs. The blockchain is the record of all Bitcoin SV transactions since the first Bitcoin transaction in 2009. To send Bitcoins, BSV tokens, you need a software called a Bitcoin wallet, and you use this to send to other people's Bitcoin addresses. All the BSV wallets that I know of are free. It is free to download them and install them on your desktop or on your laptop or just as an app on your mobile phone. It's basically best to imagine this Bitcoin wallet like your bank app that you use to check your bank balance and to transfer money to someone. You type the bank account details of the person you're sending the money to, and you press send. The same is true with a Bitcoin wallet. The difference between a bank app and a BSV wallet is that with bank apps, only the banks themselves can develop apps to connect to their servers. However, with BSV, because it is an open project, any company or individual is free to develop a BSV wallet. This means that they can innovate and improve to compete to be better than any of the other wallets in existence. The costs to transacting in the BSV network comes from the miner's fees and wallet fees. And the total of all these fees are currently so small that they are almost free. How small? They're about a percent of the amount that you are sending. So in other words, it is 1,000th. That is 0.00001 of the amount that you're sending. And I say 1,000th, but in reality, it is quite common to see 10,000th or 100,000th of the amount that you are sending. And you don't have to take my word for any of this information. You can simply test these out yourself. I demonstrated how you can transfer funds and test the network using BSV wallets like Rock Wallet, Centbee, Handcash, and Electrum SV. I'll link to the video that I've done so that you can start testing yourself. When transacting with the real Bitcoin network, the Bitcoin SV network, your transactions are settled within minutes between you and the merchant. The digital cash, the token, moves directly from your wallet to theirs. There is no need for an issuer or an acquiring bank, and there's no payment processor skimming fees along the way. The transaction is verified by the Bitcoin network itself, a decentralized protocol that ensures both parties can trust the transfer without needing any intermediaries. And this makes Bitcoin a true peer-to-peer payment system. The blockchain, which is a record of all BSV transactions, serves as a public ledger. And this means that once a transaction is verified and added to the blockchain, it is final. And the result is a more direct, more transparent, and secure payment flow. It is really like handing cash directly to someone. Once it's done, it's done. Another key element is ownership. With Bitcoin SV, you truly own your money, just like cash in your pocket. When you make a transaction, you're not leveraging credit, you're not relying on a bank to approve or deny your payment. You are simply transferring ownership of a digital asset that you control. Compare that to credit cards, where all your transactions are tracked and can be scrutinized, reversed, or delayed by the institutions that facilitate them. The need for intermediaries to establish trust in credit card payments is what fundamentally makes them more complicated, costly, and far from peer-to-peer, far from direct. Bitcoin SV transactions do not require trust in third parties because they rely on proof, not promises. Each transaction is signed and verified within minutes, with a record that anyone can independently audit. This reduces costs significantly, making transactions, micro-transactions, even those as small as a few cents or micro fractions of a cent, economically possible. With credit cards, high fees and the complex flow of money often make such small payments impractical. And for billions of people around the world who are unbanked or underserved by traditional financial systems, Bitcoin SV offers an inclusive solution. With just a mobile phone and an internet connection, anyone can participate in the global economy. There's no need to pass bank verifications, no fees to set up accounts, no hoops to jump through. Just direct, immediate transactions between two parties, between two people. This capability is revolutionary because it provides a playing field allowing anyone, anywhere to access financial services without needing to trust or depend on traditional banking institutions. And it's not just about accessibility, it is about efficiency. The process that we've just walked through for credit card payments is filled with redundant checks and inefficiencies designed to accommodate risks like fraud, lack of liquidity, or dispute handling. Bitcoin SV, by contrast, handles transactions without these bottlenecks precisely because there are no trusted third parties adding friction to the entire process. So in summary, Bitcoin SV is a genuine peer-to-peer cash system because it cuts out all the middlemen. There's no borrowing, there's no intermediation, there's no complex contracts. Just direct value exchange. You send and they receive. End of story. It's this simplicity, this return to the essence of cash that makes Bitcoin SV not just a better payment system, but the true realization of what digital money should be. Bitcoin represents a revolutionary shift, and this is why there are active efforts to prevent its success. The initial implementation of Bitcoin, which went under the label BTC, has been deliberately restricted to prevent it from functioning as Satoshi Nakamoto intended. For those interested, I have detailed the story of how BTC was sabotaged and hijacked in my previous videos and articles. The resistance to Bitcoin primarily comes from those who benefit from the current financial system. They fear losing their income, their power, and influence if Bitcoin truly succeeds. And this fear has led them to try to stay relevant by promoting Layer 2 solutions like the Lightning Network. Bitcoin has no Layer 2. Bitcoin is just Layer 1. However, history teaches us that embracing new technology leads to greater efficiency and reduced cost. Rather than focusing on what may be lost, we should adapt to and take advantage of the opportunities that Bitcoin SV offers. Just as the transition from horses to cars required industries to adapt, we too must evolve to support and benefit from this technological advancement. Thank you for watching. If you found this video helpful, please like and share it. You can also tip it using BSV. And if you find a merchant willing to accept BSV for a meal or a drink, I'll cover it. Read more about this offer in the description below. Don't forget to subscribe for more insights in how we can adapt and thrive by using Bitcoin SV, whether as individuals, as businesses, or as part of the broader global community. Cheers, this is Marquez from BSV Search.